Financials are still up 130% from March's bear market low, but in the last 10 weeks, the group has been trading sideways. So what does this say about the health of the financial sector? We're joined now on set by Jeff Morris. He is Senior Vice President at Standard Life, normally based in Boston, but here in New York for the week. Thank you so much for joining us. Now, you took up a modestly overweight position in financials following the stress test results, and the adverse scenario there called for 10.3% unemployment by next year. We're basically there right now with 10.2%. Do we need to rethink some of the conclusions, the capital needs?
Well, I think the banks have, while the stress test included a situation of over 10% unemployment, it also contemplated housing prices falling further and didn't contemplate 3.5% GDP in the third quarter. So it's not like all the conditions came together for that adverse scenario. I think some banks may need to come back and raise more capital, but by and large, the large ones have what they need at this point. The whole question of TARP repayment is the other issue that we might have to face. But for right now, I think the banks are set as a whole.
Which ones would need to come in and raise more money?
Well, I wouldn't want to speculate on individual names. There's some, it's pretty easy to go out there and you can take a look at some of the capital ratios. I think it's going to play out more along the lines of how does credit performance really deviate from expectations, and there's some areas that we're concerned about, as is others, in terms of commercial credit quality is something it's a concern.
So Jeff, clearly credit quality is one of the things that you want to pay attention to most closely as a bank analyst, but let's talk about it from an even more 30,000-foot view. Some people wonder whether you really want to invest in these large cap systemic banks at all because of the regulatory risk. Currently, as you know, neither the Obama administration nor the House Financial Services Committee nor Senator Dodd's legislation wants to break these banks up. But there are provisions, or at least there's talk of giving the Fed, for example, or some systemic bank regulator the authority to break these banks up.
Yeah, the whole regulatory uncertainty is one of the things that's really holding me back in terms of being more aggressive on the financial services sector. The House bill is enormous. The Dodd bill is over 1,000 pages. I don't think investors have really gotten through it just yet. And it's just a situation where we really don't know who the regulator is going to be. What sort of mechanism will it be in the future to deal with problem institutions, even down to things like, capital ratios, how overdraft fees can be charged, things like that. It's creating a level of uncertainty, and markets generally dislike uncertainty.
An argument not to own these stocks?
I think you want to really pick your spots, and this is a time where you really have to know the names that you're going to own. Before you might be able to say, boy, banks are cheap coming out of the stress test. They're really not reflecting the long-term earnings power. Now they've moved up substantially, and we're getting a little bit more of that, kind of in-between valuation between the panic and the prosperity, which is years out.
Now, one stock you do own is CME, which has benefited from some of the regulatory changes like trading OTC derivatives on exchanges.
Yeah, CME also has other opportunities as well. One thing we look for is increased volatility in interest rates will really drive the need for hedging. This low zero interest rate policy, won't persist forever. The Fed has issued the Treasury's has a lot of debt out there. There's going to be a need for hedging that in the future.
Jeff, yes or no question, time to take another look at Citigroup?
Maybe.
He hedges.
It's a name for later.
Thank you so much. We've been speaking with Jeff Morris, Senior Vice President at Standard Life Investments in Boston.